Welcome to Local Living Tri-City, your go-to podcast for exploring the vibrant communities of Temecula, Murrieta, and Menifee. Join me, Liz Jones, as we dive into real estate insights and local business stories, bringing you closer to the heart of our Tri-City area. Let's get started with today's episode. Hey everyone, welcome back to Local Living. I'm your host, Liz Jones, and today we're taking another dive into being a first-time home buyer and navigating the complexities. There's a lot of people on the fence about whether or not they should continue to rent or own a home. Obviously, we all want to own a home, but there's some major challenges that are obstacles for everyone. Let's talk about the down payment. That's a struggle for many people, with all the added expenses that come into our discretionary income, whether or not it's insurances, cell phones, kids' stuff, whatever. It always eats into all of our savings. It makes it difficult to save. About 15 years ago, my pastor from up on the pulpit was talking about good stewardships and what to do in the case of preparing and saving and making sure you have enough money for your home. And one of the key lessons that I took away from that was where we actually automate our savings programs. So let me give you an example. So in the automation, let's pretend you spend maybe $15, $20 a week on Starbucks. So instead of doing that, taking that $15 or $20 a week and automating it so it comes out of your checking account and moves into your savings account. Forget about it. Set it up once, automate it, and it accumulates over time. I took this challenge seriously 15 years, and I've automated a lot. Once in a while, pay attention to your checking account because it could go down. Every week, money comes out of my checking account and moves into my savings account. All I've got to stay watching is my checking account, make sure there's enough. Obviously, know your budget, what your spend is. You don't want to withdraw that account, but it is an automated process. I challenged my sister to do the same maybe 2 years ago. She hadn't saved what she wanted, and I challenged her. She started putting away $300 a month. And within months, she had $7,000 or $8,000 saved. It was incredible to watch the magic come over her face as she had power in her hands. You can stop this. I don't recommend it. Just lessen or raise the amount. So let's say things are going really well. Just say, okay, I'm changing it from $20 a week to $50. Before you know it, you're saving $200 a month. That's one great way to start saving for a down payment. Let's look at another way that we can help ourselves. It's called Snowball Effect. So Dave Ramsey is very famous. He actually is in real estate also, but he guides people in a Christian understanding of how to manage your finances. And he often will talk about the snowballing effect. And in the snowball effect, you list all your debts. And once you do that, you are going from pay off the smallest balance to your largest balance. Let's pretend you have on a credit card $50 that you owe. And so you now, at that month, 1 month, you attack that $50, turn it into zero. So you pay whatever it costs, you pay that down to zero. Next month, now you attack the second smallest. So whatever money that you're not putting on that credit card, not having to pay that bill, you take that accumulation. Now maybe it's $100, 50 on one, 50 on the other. Take 100, pay down that credit card. Keep attacking it until you've gotten all your credit cards paid off or all your debts paid off. And it's a process of saving. At some point in the future, and you watch this, it's kind of like magic. In some point in the future, you now have discretionary income that would have been paying off that credit card. All of a sudden, you have $2,000. You can move into savings. It's called the snowball effect. Let's also talk about what it's like to buy a home now. And obviously, if you were going to save the money and now you want to go after buying a house, there's down payment assistance programs, and we can talk a little bit about Dreams for All in California, but we can also talk about programs like USDA when you're buying in rural areas, so it helps you with a down payment. There is the VA loan, which we'll go into detail here a little bit as well, and then there's FHA, which is a 3.5%, but there's lots of different programs that you can
to look at. Let's work right now with a VA loan. So if you are active military or you are a veteran, you have the ability to put zero money down. Everybody knows that, but your rate of interest is better. Conventional is between 6.75 and 7, depending on your FICO scores. With a VA, you'd be looking more like the low 5s for your interest rate, so it makes it a lot easier. So also, this loan is guaranteed by a government agency for repayment, so that's why they can afford to make it less of a risk, because there's some repayment clause that helps those things out. So now, I have a story about a client of mine, and he ended up selling his house. Because he's active military, he moves every 2 years. So his family would relocate wherever his deployment was or wherever the government told him. They put zero money down, bought a house in Murrieta, and in 2.5 years, he was selling that house. The house had appreciated in value, and he walked away with $180,000 of wealth in equity. So now he takes that 180, puts it on his next home or in the bank, and does zero money again. These are great ways to snowball. He was using his housing allowance. That is something that is also open to active military. So when you have a housing allowance here of $4,000, that's going to cover you on most any house. Let's say you need something a little bit larger. Obviously, that allowance goes towards that. But at the same time, this will make the payment stand out. One of the things that I was going to say is when it comes to a principal and interest payment of a, let's say, a $400,000 loan, we're looking at roughly $2,500 in principal and interest alone. Compare that to a rent. But when you own this home, you have to pay taxes and you have to pay for insurance. Now, the taxes in this area are based on 1.1%. Now, there's special assessments. You buy a brand new home, there's a lot of special assessments. You're paying an additional $5,000 or $6,000 a year. If you end up buying an older home, special assessments are negligible. Well, you have to add that into your payment. So you've got your principal and interest, $2,500, and then you're adding into that further your taxes. Let's pretend it's $400 a month. So now you're up to $2,900, almost $3,000. And then you have your insurance. And this is coverage so that the lender gets reimbursed. Case of fire or calamity and the house is no longer livable. So that is hazard insurance. You must have that if you have a loan. Hazard insurance is probably another $100 or $200 depending on if you're in high fire. So now you're up to $3,100. Your rental payment could probably be between $24 and $32. You're in that ballpark. Now, we have to look for a $400,000 house, but you can scale that based on your housing allowance and personal needs. In the FHA, if you're an FHA buyer, this is a buyer that traditionally has no history. They're somewhat high risk, traditionally lower FICO score. There's some debt to clear, more debt than income, and you've managed to save 3.5%. So that's what they require you, is 3.5%. So that loan is doable also, and that interest rate is slightly less than you would see in a conventional loan. When renting, you're paying somebody else's mortgage, right? So they're getting wealthy on that. But when you're owning, when you make that payment, it is against your own principal amount. There's a small portion in the beginning. The longer you're in the home, the more principal you pay down. Anytime this house appreciates, which in our area last year was 6 or 7%, that percent is growing for you. Even if you were to stay pretty much the same, the appreciation of the homes tend to make a pathway of 6 to 7%. That's really awesome for you because it's automatic saving and wealth building. How does that help generational living? If your mom and dad owned a home, you're likely to own a home. Or mom and dad passes away and they give you the money from that home or the home to live in. It's helping you, your children, and your future. So I think all of us really want to set some roots. And today it's easy to sell a home, but you're not permanent here. Here's another option. You want to have a lot of properties, be an investor. First step, make it your own home. Whether a condo, manufactured home, or a house. It's not your ideal. You probably won't stay in it 7 years. Take the equity you've earned and pour it into the next house. As your income grows, so does your house. You can make two choices. Pull out equity from that house, and you can use that equity to buy your second home, and you can rent that first home. And now you have two properties. The only thing you have to look at is whether or not what mortgage you have on your first place plus the equity that you removed, does it pay for the rent that's going in that place? People like myself and my team can guide you. Pull out the equity on your house, go to a more affordable state, buy another property, and rent that house. Now you have two houses growing for you. You can gain equity and personal wealth. When you are living in your rental, a lot of times, there are great landlords. Nothing say against landlords, but there's also absentee landlords. And a lot of times the house just wears down. So you have a lot of pride, hopefully, in what you own. But a lot of times the landlord is in this state, another state is far away, and the property starts to wear and tear. There are renters that came before you, there are renters that are coming after you, and that property begins to break down. So owning your own home is a great way for you to take pride of ownership, take care of the property. Like any asset, if you don't take care of it, it will diminish the value. I have a client who's lived in her home for more than 30 years. And she raised her family in this home, and she hasn't been able to pour any love into the house, and it shows. She bought this house at $8,000 back in the 70s. And today, we valued her home, even though it's extremely tired, we valued her home at $360,000. That's a lot of growth. I'm not saying that you're going to buy a $360,000 house and one day it's going to be $1 million house, but there's a possibility. And this was something that she didn't have to maintain and still was able to get that. Had she maintained it, she'd probably be looking at a $450,000 asset. So just interesting stories about how you can accumulate personal wealth by home ownership. And let's face it, if you're in a rental, every year the rent's going up. Maybe every other time you're being told that he's going to sell it because the house values are so high. There's inconvenience. Could we stretch ourselves using these programs and find a way to get into it? If you're a household income between $70,000 and $80,000 and your FICO scores are somewhere over, let's say, 650, it's a possibility. It pays huge dividends. Our team can help you figure out those numbers. Let's talk about Dreams for All program. Dreams for All started in California a couple of years ago, and it works a lot like a lottery system. At one point in the early part of the year, you raise your hand and say, I am interested in using the Dreams for All program. At that point, you fill out an application, they put you in a queue, and it's a little bit of time, and it comes back and saying that you're into consideration or you've been selected or not this time. When that happens, they provide a 20% discount. If you're buying a $500,000 house, they'll give you 20% up to $150,000. You can use it as your down payment. You can choose to use it as your closing costs. Now, you don't have any interest on that money. The day you sell that house, whether or not it's 1 year, 20 years, the day you sell that house, you will give them back 20% of the equity and the amount. So you'll give them 20% of the equity and that. So it's zero interest loan. So you've used the government's money to provide for your future house. The appreciation is yours. It's a great program. A lot of people have been applying for it, and every area has so many. So San Diego will have a collection of how many people can bid on that in that area, Riverside County, Orange County. Check with your local lender. Let's take a quick moment to talk about property taxes. You have decisions to make when you buy a house. New houses are beautiful, and there's reason to select them. So you can buy a new house, and in that, you have something that's, you're not going to have any breakdowns. It's beautiful. You're the first person to own it. However, because they're just developing the land, schools, fire stations, police departments, you're burdening that cost in special assessments. Newer means there's more development, and older means that the schools and everything were built up a while ago. So when you're choosing your first home, it may be wise to go to an older home that maybe has been refurbished or that just needs a little love, because you can actually reduce your overall payment. Every community has a choice to become HOA or not. And for those of you, it's homeowners associations. There are restrictions and guidelines. There's management fees, sometimes gate fees, pools and amenities. If you can avoid that as a first-time homeowner, it's a great savings. Usually it's about $250. Now, with it, comes some inconsistency. Your neighbor can have an RV or boat, cut their lawn or not, and no one's going to tell them anything about that. And once you move into an HOA, you're going to find that it'll be more governed. You won't be able to paint your house just when you want it. You have to tell them what color. You will have to keep your lawn maintained. You cannot put that RV unless it's part of the association rules that RV can be in the driveway. So it's a give and a take. But when you're buying your first home, it's good to cut costs. It's fun to look online. We get a lot of clients who have found a house long before they found out what they can qualify for. This is something all of us are tempted to do. And we go for the bigger piece of pie until our stomach is wrenched. We want to go ahead and try to find something that's humble and be comfortable in it. And when we do that, a good idea is to meet with a lender, find out what dollars you could afford every month. If you're comfortable with $2,500 in your rent every single month, it's probable that you could, and not suffering, you could stretch to $3,000, which will likely be your home. If you're uncomfortable with 25, you may not be a great candidate to get started quite yet. Be counting on something around 28 to 36 for your first mortgage payment in this local area. Reach out to a lender. They're going to ask you several questions. They're going to ask you your overall income, household income. So if you're two people, the combined household income. They're going to start asking questions about your debt. That could be a car payment, could be credit card payment, could be school debt. So it could be a lot of different things. If you aren't a first-time home buyer, let's say you're just looking to buy a house, but you bought one several years ago, still have a loan on it, you'll want to disclose that to the lender. Your next purchase, if it's designed to be a primary purchase, they will need to look at that other asset and anticipate whether or not it'll be rented all the time or whether or not you'll need to pull income from your main sources to accommodate for that second property if it were vacant. So there's a lot of neat things. Not all lenders are created equal. There are mortgage brokers which shop rates. There are direct lenders who help only their customers with their lending products. They're not shopping it elsewhere. They're keeping it inside. And there are typical banks, the Wells Fargo, the Bank of America, the Chase. They also do lending, as well as credit unions. Each will offer their members something uniquely different. And if you find that you are not a good candidate with one of these lenders, you may want to seek out the alternative. So let's say a traditional Wells Fargo said you're not a great candidate for them, but you found a broker who says, I know a product for you and for your credit score and income. It's always a possibility. There are a lot of options. I want to wrap today and say that if you've been giving any kind of consideration to buying your first home, this may be a great time. We're about to go into what is traditionally the slowest part of the year, where bargains are found, where homes are about to come off the market because of the holidays. You may have an increased chance of winning an offer, of finding a great interest rate, of coordinating with a lender very smoothly because he's not overly crazy, and home prices wouldn't be bid up. If you wait till spring, it's okay. There'll be more houses to choose from, but there'll also be more buyers. You might be bidding against somebody else, which will cost you money in the long run. If you have any questions, reach out to us. I'm Liz Jones with the Jones Realty Group. Thank you. Have a great week.
Thank you for listening to Local Living Tri-City. Stay tuned for more insights and stories from Temecula, Murrieta, Menifee, and surrounding areas. Be sure to subscribe, leave a review, and share this episode with a friend that is passionate about the Tri-City area as you are. Goodbye for now, and we'll see you next episode.